Welcome to FT Markets. The bond markets are preparing for the big divergence. So what is the best strategy for bond investors should the US tighten monetary policy and the ECB loosen? And will expected QE2 in Europe help the Eurozone bond markets, or will the extra yield pickup for the US debt prompt flows across the Atlantic? We have Alan Wilde, Head of Fixed Income at Barings, in the studio to discuss the outlook for bond investors in a post-divergence world. Welcome, Alan.
Thank you, Dave.
Our first chart shows government net debt of the big Eurozone economies. The reason for this chart is just to remind us that these are historically high, particularly in the case of countries such as Greece, obviously, and Italy. Will this high in public indebtedness mean that QE2 is actually very important for the Eurozone, and does that make the case for Mr. Draghi to go ahead with a second round much stronger?
Yes, I think Mr. Draghi has primed the markets to expect further monetary easing at the December meeting. I think the original purpose of QE was to alleviate deflation pressures and to give some catalyst for the European economy to grow more strongly. And clearly there has been some success in propping up the European economy. 2015 indeed has been a surprisingly strong year for European growth, but inflation remains very subdued. And as you rightly say, the deflationary pulse that has been alleviated comes with second order effects, which are to provide low financing costs for many of these sovereign countries who need to be able to borrow cheaply for some considerable period of time. And I think that will be very much on Mr. Draghi's mind as he keeps policy easier for much longer.
I mean, is keeping debt servicing costs low, is that really going to help a country like Italy then? I mean, in the sense of getting its sluggish economy to start growing again?
Well, Italy has to run with a primary surplus because of the large amount of outstanding debt. And therefore, keeping interest rates low, allowing Italy to refinance year after year at the extraordinary levels, low levels that are available just now, is one part of restoring Italy to a better balance. Mr. Draghi is acutely aware of that, not only because he's Italian, but because Italy's problems are much bigger and would have much more importance for the European zone than that of, say, Greece or even Portugal. So it's really critical that Italy is continuing to borrow at very low levels.
And what do you expect, Alan, in QE2? Will we get an acceleration of the policy, an extension of the policy, or will we get the deposit rate, which is already negative, lowered even further? What's your expectation?
Yes, well, I mean, that is a difficult one to call. Various ECB governors have talked about the range of options available to them. I think in using the word strong vigilance, echoing the comments of his predecessor, Mr. Trichet, the markets obviously expect some decisive action from the ECB in December. That action probably now, as a minimum, to meet market expectations, has to engage with a cut in the discount rate and an extension of the policy or a widening of the tools at their disposal to provide asset purchases. I think anything that falls short of that probably will be a disappointment for the markets.
So quite an aggressive QE2 then. Our second chart perhaps shows how QE has helped the Eurozone. The green line shows that the spread between German bonds, German bond yields and US bond yields has been rising this year. What does that mean again for bond investors? Should we get QE2? Is this spread going to rise? And does that mean actually that you can get some yield pickup in the US and should start to allocate across the Atlantic as opposed to the Eurozone?
Well, there's two different things at work with QE, particularly as the US has obviously ended its asset purchase program. You're getting the benefit of a lower currency, and my expectation is that the differential, not just between 10-year bonds in the US and Germany, but also between 2-year bonds, has been the main driver of the currency appreciation we've seen for the dollar, and that differential will just widen further. Yes. If there's further QE in Europe. And particularly if the Federal Reserve also plays its part in raising rates, and we've seen that differential widen quite significantly in the last month or so, even since Mr. Draghi's last comments. At the 10-year tenor point, where spreads are wide, but not as wide as they have been this year, I think it is right to think about the opportunities in the US Treasury market in due course. And I say in due course because obviously if the Fed does begin to tighten policy, you might expect that the curve in the US will start to flatten. So as the Fed gets on top of inflation pressures, you might expect the main movement to be in short rates in the US and much less so proportionately in long rates. And I think that the spread between Germany and US is already relatively attractive, but there might be just a better entry point at some point in 2016.
Excellent. Can I just ask quickly, emerging markets, we haven't discussed that.
Sure.
A rate rise, particularly in the US, it's priced in, but could that cause some turbulence, particularly in emerging market debt?
Well, yes, it could. Short answer. It's largely priced in, and I think emerging markets have worried since the taper tantrum in 2013 about Federal Reserve tightening. So it is the most telegraphed tightening that we've ever seen in history, and it is expected by all participants to be a very shallow path of tightening. So to that end, I think you must assume that emerging markets have already priced in the Federal Reserve moving next month. On the other hand, market investors have been much more selective about their use of emerging markets, and by and large money's been flowing out rather than in. So there will be some countries that are still vulnerable. Turkey and Indonesia are the two that spring to mind that continue to have to attract money from overseas. So I think where that is the case, there are still some vulnerabilities. But as an asset class as a whole, I think at least in the short term, emerging markets probably will take this in their stride.
Great. Thank you very much, Alan. In conclusion, there are still uncertainties, particularly over what might happen in emerging markets. But critically, bond investors have an opportunity to take the advantage of diverging policy in the US and Europe as they rebalance their portfolios and put on those relative trades that might benefit from the opposite direction taken by the two of the world's biggest central banks.